Hello friends, till now we are focused on obviously the objectives of financial management. Objectives of financial management includes maximizing the profits, maximizing the returns, and then the corporate governance, as well as normally in maximizing the shareholders returns. Now let us see that normally in what are the functions of financial management. So basically in the beginning itself we know that normally finance is normally based with requirement of the funds. Okay. So it's basically when the fund is required, normally it is not required for one branch of the organization, it is required to the entire number of branches, entire number of the areas where the business is run by the organization. So in such case normally is we should understand normally what are the things which have to be noted when you look at the functions of the financial management. First one is supplying the funds to all parts of the organization. Supplying the funds means normally again whatever is the amount required or fund required, that has to be supplied to the every area of the organization. All parts of the organization means maybe for a marketing department, for R&D department, for sales department, production department, and also to human resource department. Whatever is required, that has to be budgeted, and the budgeted funds normally again has to be given to the organization. At the end normally we should also make sure that normally again there must be a comparison between actual amount of fund required and normally the whatever is the expense made, that is to be compared. If there is surplus, that surplus should be brought forward to the next budget, that is there. If there is a deficit, normally that deficit has to be met in the next budget. This is very most important. So this is very important as far as normally supplying the funds there. When you supply the funds, normally it is very important to again measure the cost of capital of the fund also. Why? Because equity may be costly one side, and second thing is normally borrowing the debts may be costly. So going for normally the public in the form of issue of shares may be cheaper when you look at normally the raising the funds. This is one side. Second one is evaluation of the financial performance of the enterprise. The financial performance of the enterprise can be measured normally by measuring these ratios. First side normally when you look at normally the liquidity of the enterprise. The liquidity of the enterprise is measured by normally the following liquidity ratios. The liquidity ratio includes one thing is current ratio. Current ratio is calculated by current assets divided by current liabilities. Current assets include cash, debtors, stock, bills receivable, and also any payment made in advance, that is there. And these are the assets which can be converted into cash within a period of 1 year. Current liabilities include normally bank overdrafts, sundry creditors, and then normally the incidental expense whatever is there. All these things are coming under current liabilities. The thumb rule states that the current ratio must be 2:1. 2:1 means 2 is the size of assets, 1 is the size of liability. Industry rule says that it must be 1.33:1. 1.33:1 means 1.33 should be the size of asset and 1 should be the size of liability. That is one side. The logic behind this is asset must be greater than liability. One thing. Second thing is normally the quick ratio. Quick ratio is measured by normally the current assets minus inventory divided by current liabilities. When you take inventory out of all the current assets, normally we will get the quick ratio. The thumb rule is 2:1 there, and industry rule is 1.33:1. There are many industries which are maintaining normally the current ratio above 2:1 also. Okay, this is one side. So, but normally again we find that general thumb rule is like this. Okay, third one is called as super quick ratio. Super quick ratio is measured by normally current assets minus inventory minus marketable securities divided by current liability. There also thumb rule is same, industry rule is also same. So this is there. So the liquidity ratio measures the liquidity of an enterprise. The liquidity refers to the firm's ability to convert its assets into cash within a span of 1 year time. This is one side. Second type of ratio what we measure is profitability ratio. The difference is in the case of liquidity we measure it in numbers, in ratio, and then normally profitability is normally measured in terms of percentages. Percentages means how much returns we are getting on investment. That is the first ratio to be measured here is normally called as gross profit ratio. Gross profit ratio is given by gross profit divided by sales into 100. That is there. Second one is net profit ratio. Net profit ratio is given by net profit divided by sales into 100. So there we measure normally in two things there. What is the gross profit and net profit earned by the enterprise in the respective year. So this is one side. And next area to be focused on the financial performance is normally to measure normally the turnover ratios. The turnover ratios we measure 3 turnovers. That is, first one is called as your debtors turnover, second one is creditors turnover, and third one is stock or inventory turnover. The debtors turnover is measured by normally the total number of debts divided by total number of days in a year, or normally it is given by normally the net credit purchases divided by number of days. Okay, likewise it is. Similarly, in the case of normally the creditors turnover, it is net credit the purchases divided by the number of days in a year. Likewise, Inventory control, the inventory turnover ratio or stock turnover ratio is given by normally the cost of goods sold divided by average inventory. Cost of goods sold is measured by normally it's given by gross profit minus sales. Sales minus gross profit is one side. And normally your average turnover is given by normally the turnover in the beginning plus turnover at the end divided by 2. That is beginning turnover plus the turnover at the end divided by 2. Likewise, normally measure normally the stock turnover of an enterprise there. So this one side. So these measures normally the basic financial performance of an enterprise. So the corporate level normally we are interested to know normally what is the return on investment ROI, return on equity ROE, return on assets that is ROA, and return on capital employed. So this is more important when you look at normally measurement of financial performance, because normally in year on year when the financial performance is measured, normally a firm should do better when you compare to the last financial year. This one side. Third side, negotiation with the suppliers, with the credits and creditors, and also negotiation with the financial intermediaries to the banks and other things. So there we negotiate by, because when the firm is borrowing normally for a temporary projects, so in such case normally the rate of interest matters there. So rate of interest should not be that strong. Rate of interest should not affect the interest of the company. That is one side. It must not affect normally the respective cost for the company there. So that is there. So profit should not decrease because of higher rate of interest, or company should not get the burden of finance because of paying additional interest. So in such case they negotiate with the suppliers. That is one side. Next one is track of stock exchange quotations. Okay, so stock exchange quotations has to be noted by, because price movements changes in the stock market every time, is it not? So that is one side. And second thing is normally when the price movements change, that will have an impact on the business of the company. If the stock price rises, it is good. Stock price moves down, definitely there is an impact about this. So it's very important to keep track of stock exchange transactions. And then when you look at the stock exchange transaction today, the stock exchange transaction is not free from risk of volatility, risk of normally the liquidity and other things. So in such case normally we should also understand these things also when you look at stock exchange quotation. Next one is financial control. So financial control means normally we should know that normally what are the terms of credit given to the creditors, terms of credit given to the suppliers, terms of credit given to normally those people normally who are dealing with the business. The terms of control means when we lend, normally we should make sure that recovery is done on time. When we again borrow from others, we should also make sure that the payment is made on time. That is very important. So we should know what is the position of receivable. We should also know what is the position of the payables. Knowing these two will have a greater impact on the financial control, because at the end of the year normally your capital should not come down. At the end of the year your earnings per share should not come down. At the end of the year credibility of the firm should not come down because of low financial performance. So all these things has to be kept in mind when you look at financial control. Financial control can also happen when normally the people have normally their track on their spendings should be minimized. That is one side. Cost should be minimized, and then normally profit should be maximized. Then it's possible to have a proper financial control. That is one side. A financial control can also be done by normally by recording all the transactions correctly on time. That is also one thing. Next, keeping record of all the business. Financial record of all the business becomes very important. There is an also. So in the group of companies you might have seen that normally the managing director will know what is the normally turnover of the enterprise for organization 1, 2 like that. That is one side. What is normally the size of assets, what is the size of normally the liabilities, how much is the investment which has been earned through the IPO routes, how much is contributed by the investors, and then how much dividends are paid to the investors, and then normally what are the ways in which normally we are increasing the profits. So all these things normally the business, the CEO of the firm will be knowing. So that is there. So in such case normally he is keeping the track of all the businesses, track record of all the businesses. So it's very important to be in the market. It's very important to continue with the best finance. So in such case normally what is required is normally we have to just follow normally what are the basic functions of the finance. Now to sum up what we can say is the functions of the finance includes, first thing is supplying funds to all parts of the organization, evaluating the financial performance, negotiating with the suppliers, trading on a track of stock exchange quotations, financial control, keeping record of all the businesses. Thank you very much.